Good afternoon and welcome to the lecture 24 of ETC 779. In this particular lecture and few more lectures, we will be covering basics of accounting. We will see what are the concepts involved in accounting, what is so special about construction accounting, why we are trying to go through this particular course content. We will try to see what are the different accounting statements such as balance sheet, profit and loss account, and then changes in financial statements. Besides this, we will also be going through the discussion on working capital. So, this is just the outline of few lectures which we are planning to have as far as construction accounting is concerned. Of course, the basic objective, if you see this particular slide, you will find that we are not going to give you the detailed analysis of how to prepare the account statements. Our intention here is to introduce you to the basic concepts of accounting as far as construction accounting is concerned. Now, if you see, there are different types of accounting, starting from, let us say, household accounting. You buy some household goods, you spend some money, you try to keep record of that and then try to balance it with your income. So, that is household accounting. Then you have different types of business accounting in which you invest some money, you get some return and then you do some expenses. So, these things you try to keep a proper record. That is also part of accounting. But if you try to look at the construction accounting, it is slightly different compared to other types of accounting system. This is because of the peculiar situation of construction projects. If you remember our previous discussions, we have already discussed that construction projects span for a large duration of time. Could span from, let us say, 6 months to 1 year to 18 months, 24 months, maybe 3 years, 5 years, to that extent. And then there are many uncertainties involved. So, the first thing which makes it different is construction accounting, basically construction projects span for very large duration. Sometimes you may have 2-3 financial years coming in for a single project. Then it becomes very difficult to see what revenue to recognize, how much profit to report and how much losses if we are making, how we should report that. So, these are some of the special situations in construction which makes construction accounting slightly different from other accounting which are followed in, let us say, manufacturing industries or let us say in some other business. So, our objective here is basically to introduce you to some of those concepts of accounting which are special to construction accounting. And then the most important objective of this particular course is to basically equip you to handle day-to-day accounting basics. For example, as you know, accountants handle the accounts part, right. There are construction accountants who have got expertise in this kind of dealings. Now, as an engineer, as a manager, what you are supposed to do is, you should have at least some understanding how these statements are getting prepared, and then you must be able to interpret those statements. There are certain parameters which you must be able to appreciate, that if they are increasing, whether it is good for you, whether it is bad for you. So, such type of interpretations we are more concerned with. So, do not think that by doing this particular course or by going through these particular lectures, you will be able to prepare the balance sheet or the profit and loss account. No, our intention is not that. We are concerned more about interpreting the results reflected by these financial statements. But before going into those interpretations part, we would also like to know what exactly accountants do. We would like to see what are the assumptions involved in accounting, what are the different accounting statements, what are the different books that the accountants maintain. So, that is the basic objective of having this particular discussion, to introduce you to the basics of accounting, especially construction accounting, and to make yourself comfortable in interpreting those statements which the accountants prepare. So, keeping these two objectives in mind, we will straight away move into the details of this particular course. Now, just to define accounting, it is like a language of business. So, like any other language, it basically aims to communicate the business transactions effectively. So, it is a language of business through which we are able to communicate the day-to-day dealings of our business. Now, when I am talking of transactions, it is basically those activities which involve change of money or which involves money. Now, accounting has been defined as a system of recording, collecting, summarizing, analyzing and presenting information about an organization or project in monetary terms. You will find that the currency is the basic parameter. Everything we are trying to measure in terms of money, that we are recording, we are collecting informations from various sources, then we are able to analyze them and present it in some predefined manner. So, it is basically all these activities put together is nothing but your accounting. Now, the findings of this particular exercise are usually reported in the form of a balance sheet, a profit and a loss account, and a statement of changes in financial positions. So, these three are very important documents which are the outcome of the entire business of doing this accounting. So, what for we are doing this, all these activities such as recording, collecting, summarizing, analyzing, just to present them in some predefined formats, so that it is easy for all the stakeholders to analyze the results. Basically, this is like a performance report, what the company has been doing over a given period. These statements very well reflect. Now, you will find that the statements which we have talked just now, that is balance sheet, profit and loss or income account, or the statement of changes in financial positions, these things are of interest to many persons, many stakeholders. For example, it could be of interest to owners who are owning the business. It could be of interest to management of companies, top management, middle management. It could also be of interest to potential investors. Suppose there is a company X, some investor Y wants to invest in it. So, until and unless he is assured of the health of the company, he may not be willing to invest in the particular company X. So, he is having this kind of interest. Then there could be financial institutions which may be of which may be trying to look for these statements. then there could be credit rating agencies, then your own employees. They would also like to know what is the status of the company, whether the company is doing all right or whether it is going through rough patch. So these things you try to look through the statements which is prepared using the accounting exercise. Now the analysis of the statements is left to the user. So as far as accountants are concerned, you will find that their job is to just prepare the statements. They are not bothered who is interpreting how those statements. So that's why we say that the analysis or the interpretation of the statements is left to the user, because different stakeholders will have different interest. For example, if you see this particular slide, it says an investor may have different interest, tax authorities may have different interest. Interest of what? Looking at the financial statements. For example, an investor would look at this statement to find out the prospects of their investment in the company. Suppose I am the investor and I am looking at a financial statement. I will try to look at those parameters which gives me confidence that fine, my investment is safe here, my investment is secured here. Now if I am a tax authorities, I may see what is the tax liability of the company, how much profit the company has made, and then what is the liability of the company. Similarly, if you see the employees, what are their interests? They would like to look for the stability, whether my job is safe or not, because I know that if the company is not doing well, I may be thrown out. So an employee has got different interest. Similarly, creditors, you will find they will have different interest, whether the amount owing to them would be paid when due. Creditors are basically those entities which give you money to them, which give you money. So looking at the financial statement, they would like to see whether the money which they have lent to this particular company is safe or not, whether the company would be in a position to return the loan amount or not, or whether it will go bankrupt. So what you find here? Different stakeholders having different interests. So without going into these nitty-gritties, the role of accountant is just to prepare the statements in an unbiased manner. Let it be interpreted by different stakeholders for different reasons. He should not be concerned with that. So what you have to see is that it is always important to know for whom you are keeping the account. For example, you may have started a company. So when the accountant writes the personal account for you, it would be different. But when the accountant writes the account for the company, it would be different. So it is very important to understand the perspective or the person for whom the accountant is keeping the account book. This aspect we will be discussing in greater detail little later. Before that, we would just like to understand the different assumptions that construction accounting has. For example, if you look at the first assumption, it says transactions should be recorded from the viewpoint of the person for whom the accounts are maintained. Now, this will be more clear if you look at the example. In the example, I have assumed that supplier sells X bags of cement for rupees Y to the contractor. So, there are two entities involved here. One is supplier, another is contractor. Now, supplier is selling cement to the contractor. How much cement has been sold? X bags of cement. For how much? For rupees Y. So, it is very important to know for whom you are trying to write the account, because if you are trying to write the account for supplier, it would be different. If you want to write the account for contractor, it would be different. Going back to this example, if you see, in the supplier's account book, stock will get reduced by X bags. So, there would be depletion of stock, decrease of stock by how much? X bags. And his sales would show a value of Y, because he has sold this much money, this much cement bag for rupees Y. So, there will be a sale of Y besides a depletion of stock equivalent to X bags. So, this is as far as supplier's account is concerned. Now, if you try to look for the contractor's account, it will show just the opposite. For example, they will show the increase in stock of X bags, whereas Y would be recorded here as an expense, because Y amount has been spent to acquire X bags of cement. So, this is what is meant by the perspective for whom you are writing the accounts, and that is the first assumption and very, very important assumption as far as accounting goes. Now, we move on to next assumption of construction accounting. It says, assume that the establishment is going to exist forever. That means it is not that you are into business today and tomorrow you are closing the shop. No. We are assuming that the corporation or the company or the firm or the entity is going to last forever. So, that is the second fundamental assumption here. And the third assumption, if you see, provide for all prospective losses, but do not account for prospective profits. This is very, very important, and in this sense, you can treat accountants as a person who is quite pessimistic, because they advocate that account for all the prospective losses. The moment you smell that you are going to incur some loss, show it in your account, but until and unless you are 100% sure that you are going to get this profit, you do not report that. So, in that sense, they are quite conservative, or in other words, you can say they are quite pessimistic, but they have reasons to do so, because construction industry, construction projects are full of risks. Till the project is completed, you do not know what is going to be there in the future. So, they do not want to take any risk. Suppose they have estimated that some profit is going to be there, but it so happened that due to some reason you have lost some money. So, then that will be a wrong reporting. So, what they do to avoid such situation is to report only the prospective losses, which they see that okay, in near future such kind of losses are likely to be there. For example, material prices might go up, or they might have more wastage. So, these things they are quick to respond to in the form of showing losses, but when it comes to reporting profit, they want to be 100% sure. So, this is also known as principle of conservatism, or maybe you can say a pessimistic approach. Then moving on to next assumption, it says sum of debits is always equal to the sum of credits. In other words, the total funds owned are equal to the total funds owed. The term owned and owed are very important as far as accounting is concerned. This point we will be covering in detail. Sometimes this is also known as principle of double entry. Nowadays, it is mandatory to follow this double entry system, in which you have sum of debits always equal to sum of credits. These points we will be discussing in detail also. We move on to next assumption, which says costs and revenues are taken into account or accrued as and when they are incurred or earned, rather than when they are paid or received. So, in the previous example, in which there was a supplier selling X bags of cement to the contractor, so we are not bothered when exactly the supplier received the payment. No, we are not bothered. The moment the sale was over, we say that okay, transaction is done, and we are not waiting for the real payment to be received. So, this is what is meant, that costs and revenues are taken into account as and when they are incurred or earned, rather than when they are paid or received. So, it is immaterial at what point of time you are receiving the money or paying the money, as long as you have made the sale, it is all right. So, this is also sometimes known as the principle of accruals. So, we are not actually waiting for the moment at which time we are going to receive money or we are going to pay the money. And then you have one very important assumption, which says that identical or very similar items must be treated in the same way in different accounting periods and in different sets of account. That means you have to be very consistent. Otherwise, the whole purpose of accounting will get defeated. As and when you go through the topic in detail, you will find that there are many situations in which an accountant has to exercise his personal judgment. Many situations wherein it calls for judgment of the accountant. That means it becomes subjective at times. Now, at every point of time, if you start writing the accounts differently, it will be very difficult to be interpreted. So, that is why it is said that no matter what you follow, but follow it consistently, so that your act is being interpreted correctly. So, that is very essential, because at many point of time you will find that an accountant has to use his judgment, and that is why we are concerned that it should not happen that on one occasion he is using something else, in another occasion he is using something else. So, this is what we have to be very careful about. Now, we will straight away move into the process of accounting. We are interested in knowing how accounting statement is being prepared right from transaction number 1. That means, what are the different steps involved? See, the ultimate outcome of an accounting exercise is balance sheet, profit and loss account and some other statements. But what actually goes into before these final outcomes come? We try to understand that process. Now, if you look at this particular slide, this gives you different steps which are required to be performed in order to complete your exercise, in order to get the outcome of outcome in the form of a balance sheet or a profit and loss account, sometimes also known as income statement. So, the first thing or the first step is the initiation of transaction. Step 1 is initiation of transaction. Step 2, keeping records of transactions in chronological manner. We will go into the details of these slides one by one, but you may copy it. Then making adjustment entries. Then you have to record the transactions in T account or ledger. So, T account is also referred to as ledger. Then you prepare the trial balance, which leads to preparation of profit and loss account as well as closing of remaining T accounts, and then finally you get the balance sheet. So, no matter how many transactions your company is doing, the accountant has to go through this process in a very systematic manner in order to arrive at a balance sheet as well as profit and loss account. You must have noticed that I am giving too much emphasis on preparation of balance sheet and profit and loss account. There are many other statements which accountants prepare, but then you will find that these two are very important as far as an engineer or a manager is concerned, because using the parameters available in balance sheet and profit and loss account, we try to find different ratios which indicate the financial soundness of the company or the health of the company in terms of its financial soundness. That is why we are putting more focus on these two statements. So, these are the different steps which go for bringing the two outcomes. Now, what we do? We go into each of these steps one by one and try to understand what it is. For example, if you see the initiation of transaction, now we are calling transactions here as those events which involve money. So, now you must be realizing that there are numerous transactions which are being carried out by a construction company day in, day out. For example, you may be purchasing the material, it could be aggregate, it could be cement, it could be steel, it could be marble, it could be granite, it could be doors, windows, curtain wall, glazing, different materials you may be requiring at different point of time. All these involve money because you have to sell out some money to buy them. Similarly, you must be receiving money from your client at regular interval. Your company may be into some other businesses also other than construction. So, you may be receiving some payment from there also. So, these are all different transactions. Now, in addition to this, there are certain other things also which is very difficult to assign monetary value. For example, your company may have certain patents, or the company might have earned certain goodwill in the market. They must have a very good reputation. So, right now we are not dealing into those things. What we are concerned here is those transactions which are involved with certain money aspect, certain monetary aspect. Now, the accountants come into action only when transactions take place. If there is no transaction, accountants would be sitting idle. They would be just occupying the chair. But the moment some transaction has taken place, they will be quite active. Now, for all these transactions, they would like to see the record. The record could be in the form of a bill, in the form of an invoice, in the form of a delivery challan, in the form of a material receipt note. So, until and unless they have got documentary evidence, they won't act, they won't treat that as a transaction. Suppose you simply said to your supplier, send me this much bags of cement or send me 1 ton of steel. As far as accountant is concerned, this is not a transaction. But for him, the transaction would be complete when he receives a bill equivalent to 1 ton of steel. So, let us say the supplier is charging you maybe 50,000 rupees and he has sent you an invoice or he has sent you a bill. So, then only it is treated as a transaction in the eyes of accountants. Without documentary evidence, they do not act. That is why you must be finding that all your accounts people, they will always like to get something in writing, because they have been taught this way, that no, until and unless you have certain proof in the form of certain documents, the transaction is not to be considered. So, first requirement for a transaction is that you must have certain documentary evidence, and then these documents are stored properly, because you have to produce them whenever any audit takes place. The transaction won't be taken as a valid transaction if it is not supported by a proper document which is with the company or which is with the accountant. So, these 2 points are very, very important in order to initiate a transaction. Not only you should have the documentary evidence, but those evidences must also be properly kept, so that at the time of auditing they can be produced to the auditors. There could be either internal auditing, there could be external auditing. So, at all point of time you must have record of all the documents which you have entered as a transaction in your accounting. So, this is as far as step 1 is concerned. Now, we move on to next step, keeping records of transactions in a chronological manner. That means you start recording your transactions as and when they come. Suppose you have received a bill from Messrs XYZ, rupees 500,000 on maybe 5th of September. Then you must have received certain bill on 6th of September, 7th September, maybe 10th September. So, they are to be arranged in a chronological manner as and when they occur. That means you have to put them in order, maybe date wise. Now, what we do, we classify transactions into 2 types here. One we call cash transactions, another we call non-cash transactions. We are distinguishing it here because both get different treatment by accountants. Even the place of their recording also changes. For example, you will find that all cash transactions means those involving direct cash, the liquid money, right? All these cash transactions are recorded in cash book, whereas the non-cash transactions, they are recorded in journals. So what you do in step 2? Record all the transactions chronologically. Now, as and when these transactions become voluminous, or let us say considerable, maybe 20, 25, 30, you start recording them either in the cash book or in the journals. All cash related transactions are recorded in cash books, non-cash related transactions are recorded in journals. Now we will see what is cash book and what is journal. As I told you, these cash books keep the record of all the cash transactions in a chronological manner, day-wise, date-wise. So, at any point of time, you would like to know what is the cash balance of the company, you can find it out from this cash book. It will have all the details of cash transactions. So, you just need to sum it up and you will be immediately able to understand how much cash is there with you at any point of time. So, this is what the utility of cash book, maintaining cash book account. This part we will be discussing in more detail after we complete all the steps of accounting. I will show you how actually the cash book looks like, what are the serial numbers usually used, and how to transfer these entries into some relevant account books, that we will see little later. For the time being, just understand that transactions are recorded in a chronological manner. They are distinguished between cash transactions, non-cash transactions. Now, cash transactions are recorded in cash book, non-cash transactions are recorded in journals. The name journal is because it is the first point of entry. Now, you must have seen many scientific journals. What they do record? They record any new development in that particular field. So, that means any development is recorded for the first time in these books only. That is why here also, since the non-cash transactions are entered into this particular book for the first time, we are calling them as a journal. Now, the journal records both the debit and credit sides of the non-cash transactions. We will discuss about what is debit, what is credit, but wait for some time. Just understand that it has got two sides. One side has got a debit column, other side has got a credit column. Now, as I told you in the beginning, when discussing about the assumptions in the accounting, we use the term double entry. That is why you will find that all the non-cash transactions are recorded in the journals under debit as well as under credit column both. We will see how it is posted. Now, in double entry system, you will find that debits are defined as resources flowing into the accounts. That means, whatever account you are receiving, that goes under debit, and whatever resources are flowing out, that are kept in credit side. So, resources flowing into the accounts in debit side, resources going out of your accounts or the accounts given, that you put it in credit side. Now, this is what your typical journal looks like. If you see at the bottom of your slide in table 1, a typical journal has been shown. So, what you see, the leftmost column gives you the date on which the non-cash transaction has been entered into. Then you will have serial number, then you will have account. Now, you can see under account we have debtor and debit amount of 300,000 has been kept, and then under account itself we have got sales, for which we have entered a equal value of 300,000 under credit side. So, what you find? This is a typical example of double entry system. Single transaction has been recorded both under debit as well as under credit. Some of you, if you are not able to understand this debit and credit, don't worry. We will try to show it through a small illustration and it will be very easy to understand. So, don't worry if you don't understand at this point of time. We will try to make it very simple after just few moments. Let me just complete the entire accounting process. Now, these are some of the conventions that are used for posting the transactions or recording your transactions. This you may like to note it down, because this we will be using it in this particular lecture. For example, when you find that there is an increase in asset by a certain transactions, that is recorded under debit side. So, the first column, if you see, it gives you item. For example, asset, liability, expense, income. We will talk in detail what is meant by asset, what is meant by liability, what is expense, what is income. We will discuss them in detail. For the time being, just understand that these are the 4 major categories, right, and how they are posted, how they are recorded in journals whenever you have either the increase or decrease in them. So, for example, if you have got increase in asset, they are recorded in debit side. If there is a decrease in asset, then we are recording it in credit side. If there is an increase in liability, we put it under credit side. If there is a decrease in liability, we put it in debit side. Similarly, if there is an increase in expense, we record it in debit side, while if there is an increase in income, we put it in credit side. This table you please note it down. We will be using them to illustrate you some transactions, how they are recorded. Then once we are able to identify cash transactions, non-cash transactions, and we are able to put them under proper book, then we have to make certain adjustment entries. You will find that there are many transactions which the company continues to do every moment. For example, depreciation. The assets of the company is getting depreciated every moment. They are having reduced value as and when time passes. So, for example, you have purchased some equipment for, let us say, 500,000 rupees. At the end of year 1, let us say, it has lost its value by 100,000. Let us say depreciation is 100,000. So, its book value is going to be 400,000, right. Now, 100,000 value has been lost over a period of 1 year. That means every month we are losing by 100,000 by 12. Every week we are losing the depreciation by 100,000 divided by 12 into 4, assuming that there are 4 weeks in a month. That way you can calculate the daily depreciation also, how much each asset is undergoing depreciation every day. So, if you try to include these things also in your day to day accounting, your life will become very, very difficult. So, what we do? We do not take such transactions on a daily basis. What we do? We find these transactions or we make entries of these transactions only on that particular day or only on that particular instant at which we desire the balance sheet. I will tell you in another manner. Suppose you desire the balance sheet to be prepared on 31st March 2009. So, you should try to find out how much depreciation has been there during the period 31st March 2008 to 31st March 2009. That only you consider in your transactions instead of having daily transactions of depreciation. Similarly, you take the case of labor wages. Labor is doing work for you every day on a daily basis. So, his wages are accrued on every moment, but you are paying them only at the end of a month. So, such transactions are not recorded on a daily basis, but they are compiled only on the day at which you want the balance sheet. You will find that balance sheet is nothing but the snapshot, a picture taken at a particular moment. That is why you will always find that companies report balance sheet as of a particular date. For example, if you go through the annual report of any construction company, you will find that they report the balance sheet as of, let us say, 31st March 2009, as of 31st March 2008. Why? Because until and unless they report that particular date, the entire balance sheet may be changed at some later date, because as you will see through some example, every transaction changes your balance sheet. So, it is possible to make balance sheet for every transactions that you enter. That is why you have to freeze the particular time. That is why it is known as snapshot. Your picture may change different moment. You may look something else at some point of time. After some point of time, you may look something else. So, you have to specify at what point of time you have taken this snapshot. That means, till what point of time you have captured all the transactions. So, these adjustment entries are made on a given date. We will see that, because every transactions can alter your balance sheet. We will see this through a small illustration. and that is why these entries are known as adjustment entries. Then finally, what we do? We record the transactions in T account or ledger. So, all the transactions are recorded in T account or ledger, right. We will see how to record transactions in T account or ledger. For this, I have already given you the sign conventions. That means increase in asset, where it has to be posted, whether in debit side or in credit side. Increase in liability, whether I should put it in debit side or in credit side. So, using those conventions, we will try to record those transactions in T account, which is also sometimes referred to as ledgers. Now, in a ledger, you will find that the debit entries are recorded on the left hand side and the credit entries are recorded on the right hand side. We will see how a T account or ledger looks like. This is the picture of a typical T account. So, what you see here, on your left you find debits, on your right you have credit. Now, transactions are recorded. For example, you have purchased a building, that we are calling as transaction T1. Let us say the company has purchased the building for 100,000. So, what has been done? Building is an asset. So, there has been an increase in your asset because you have purchased a new building. So, definitely your asset has increased. Now, if you look at the table which was given to you just a few moments back, it is written there, increase in asset is recorded in debit side. Can you find it? So, that is why you can see in this particular T account, the transaction involving purchase of building has been shown in debit side. Now, it will require little imagination why it is called T account. It is of the shape of a T. If you extend the center line, you will find that it is taking the shape of a T, and that is why it is also known as T account, whereas more popular name is ledger. So, you know how to record transactions in T account or ledger depending on the nature of transaction. For example, increase in asset, I will record it in debit side. Increase in liability, I will record it in some other side. Increase in expense, increase in income, I will write it at appropriate places. Then comes preparing initial trial balance. So, what we do in this step is, whatever T account we have maintained, that are to be closed. How it is closed, we will see with the help of an example. But for the time being, please understand that all the T accounts or ledgers entries which we have made for different transactions are to be closed. And this particular step is a must for preparing the balance sheet as well as profit and loss account. Now, while closing the T accounts, you will find that sometimes there could be debit balance, sometimes there could be credit balance. Sometimes there could be debit balance, sometimes there could be credit balance. Now, these are to be carried over in the initial trial balance. And once you do this, then we are ready to get the profit and loss account. Then finally, at the end of profit and loss account preparation, there would be some more T accounts which needs to be closed, and that any balances is taken back to balance sheet. We will see with the help of an example how to perform these statements, how to prepare these statements. So, these are the different steps involved in the process of accounting. Right. Now, what we do straight away, we move on to some small exercises, so that whatever steps we have discussed, we are able to make them and understand them in a more better manner. Now, look at this particular example. Actually, there is one student who intends to start a construction company. Now, he wanted to start the company and start with the trading business. He had been saving some money every month from his scholarships. Let's call that person David. Now, David has got his degree on June 30th. Right? We are trying to go with a very small example, very simple example, but it will be able to clear all your doubts. So, there is a student who intends to start a construction company of his own after graduating, after getting the degree. He got his degree, and for opening this company, he has been saving some money from his scholarships every month during his graduation. So, let us say on July 1st, David withdrew rupees 100,000 from his bank and announced the formation of the ABC Trading Company with this amount as the initial capital. Right? So, he has got his degree, he has got money with him in his bank account. So, he has withdrawn rupees 100,000 from his bank and started the company. He has named the company as ABC Trading Company. So, as far as transaction 1 is concerned, this is over. What has been done? David has withdrawn rupees 100,000 from his own bank account and started this company using this money as the initial capital. Now, let us work out, or let us make the account for the company, ABC Company, and not for Mr. David. Is it clear why I am asking you this? Because in the beginning itself we discussed that it has to be made very, very clear for whom we are writing the accounts. So, in this particular exercise, I am interested in writing the account for ABC Trading Company and not for Mr. David. Now, just a while ago, I also told you that every transaction can result in a changed balance sheet. So, with this transaction, can you prepare the balance sheet of the company, ABC Trading Company, as of July 1? Now, I have put a rider as of July 1, because I told you that balance sheet is a snapshot kind of a thing. So, you have to specify this is as on what date, because tomorrow it may change. That is why it is very, very important to specify the date at which you have drawn the balance sheet. So, in the balance sheet, in a typical balance sheet, you report assets as well as your liability. and the name balance sheet is coming from the fact that any balance sheet you take, you will find that the assets column are matching the liability column. Now, there are different assets, but first of all we must know what is asset. Asset is what the company owns, and liability is what the company owes. So, these are two very, very important terms. I told you in the beginning, what you own and what you owe. So, whatever the company is owning is termed as asset, and whatever the company owes is your liability. Now, there are different types of assets. You have got fixed assets, you have got current assets. Similarly, there are different types of liability. You have long term liability, you have short term liability. These things we will discuss in detail when we cover the interpretation of balance sheet, interpretation of profit and loss account. For the time being, just understand that whatever the company owns is to be treated as an asset, and whatever the company owes is to be treated as a liability. Now, in transaction 1 of the ABC Trading Company, it is told that Mr. David has withdrawn rupees 1 lakh from his bank account and used this as an initial capital to start his company, ABC Trading Company. Now, let us try to find out, let us try to prepare the balance sheet for this. So, what we do here is, I write in the beginning itself balance sheet of Messrs. ABC Trading Company as on July 1st. Now, this is very, very important, because maybe next day the balance sheet would change. So, what I have done is, till July 1st, I have frozen the transactions and I have considered only those transactions which have been completed by July 1st. In this case, it happens to be only one transaction, but in general there could be many transactions occurring on a day in day out basis, and so you have to have a cutoff, and that you have to report it as of what date. So, this is being prepared for as on July 1st. So, the balance sheet has assets here, and then at the bottom you have column for liability. Now, as of July 1st, the accountant will see what the Messrs. ABC Company owns and what it owes. Remember, we are writing the account book for the company and not for individual Mr. David. This is very, very important. So, can you tell me what the company owns at this point of time? The company is owning the cash of 1 lakh. Initially, the cash available with the company was 0, and from 0 it has been increased to 100,000. This is also sometimes known as opening balance. So you can have opening balance here, opening balance. So my opening balance for the company as on July 1st was 0. Now the assets have increased by 100,000. That means the company is owning a cash of rupees 100,000. So this is as far as assets are concerned as on July 1st. Now what is happening to liability? What is the liability of ABC Trading Company as on July 1st? Liability is the capital provided by Mr. David. So the company owes rupees 1 lakh capital of Mr. David. So here I write capital, liability is capital of 0 plus 100,000. So here I have got a total liability of 100,000 as well as the total asset of 100,000. This is what is meant by balance sheet. What you find, the assets as well as the liabilities are balancing each other. Now sometimes it may look odd that how come the capital provided by Mr. David is the liability. But this will get cleared off very easily when you see that this account is being written for ABC Trading Company. So this company is an entity. Forget about David. This company is separate entity which is now holding cash of rupees 100,000. So it's owning an asset of 100,000 and it is owing rupees 100,000 provided by Mr. David. And you find that assets and liabilities both are matching and that way it is balanced. So its name is balance sheet and we have drawn the balance sheet as on July 1st. Now let's take another transaction. Just read this. If you look at this particular slide, it says just when David was about to start trading, his seniors told that, if you look at this particular slide, can we have this slide please? Okay, I will read it out. Just when David was about to start trading, his seniors told that he was being terribly old fashioned. How could he run a business without a bank loan? This is the background, just to make it little interesting. So just when the student David was about to start trading, his seniors advised, come on, you are doing business and without a bank loan. You are an old fashioned guy. So on July 2nd, David went to the bank, feeling a little nervous. Of course, he has reasons to be nervous because first time he is going into such scenario. But the bank manager recognized him. Oh, you are the recipient of President's Gold Medal this year. The nation is proud of you. Well, if you want only rupees 50,000, here it is in cash. Our door is always open if you want more. So, forgetting about the story part, just try to see what is the transaction on July 2. So, David has been able to get a loan of rupees 50,000 for the company. Now, with this transaction, if you try to put them in a balance sheet, you will find that the balance sheet changes. That is why it is always important to put the date. So, now with this transaction, can you try to prepare the balance sheet as on July 2? Now, this I have done it for you. You can find the balance sheet as on July 2 here. So, under assets, cash is further increasing by an amount of 50,000. So, my opening balance was 100,000. Now, I have got 50,000 more. So, you can find it is recorded under asset side under cash. So, now my total asset is 150,000. Now, what are my liabilities? This bank loan is also the liability of ABC Trading Company. Why liability? Because you owe this money and the bank has provided you this much money. So, it is not your own money, but that provided by the bank. So, what you find that here again, yes, okay, I will, doesn't matter, we have not, you have not left, I mean you have not missed much. So, I will repeat it once again, do not worry. We are talking of second transaction in which the company has got a bank loan of rupees 50,000. So, what this transaction has been able to do? It has increased the asset, cash asset in particular, from rupees 100,000 to 150,000. So, you can see the assets column is showing you an amount of 150,000 and liability column also is showing 150,000. Now, we move on to next transaction. On July 3rd, David bought a small shop building for rupees 25,000, paying cash to the pleasant surprise of the seller. His seniors in the municipality helped him to register the building purchase quickly in the ABC Trading Company's name. So, this is as far as the transaction number 3 is concerned. The company has bought a small shop building for rupees 25,000, that too in cash. So, if you try to incorporate this, you will get a balance sheet like this. Now, look at the asset side. In addition to cash, we have got one more type of asset here, which is building. Now, the opening balance sheet as far as building asset was concerned was 0. And now, from 0 its value has increased to 25,000. So, 0 plus 25,000, you have 25,000 as building assets value. Now, if you look at the cash under asset side, there has been a decrease of 25,000 in this particular asset, because you have purchased the building in cash by paying 25,000. So, what you find, your cash has come down to 125,000. Yet, the total value of assets is again 150,000, but the composition of assets have changed. Earlier, I had got 150,000 worth of cash alone. Now I have got only 125,000 cash and remaining in the form of building assets. And with this transaction there has been no change in liability, because we have not added any liability as far as the company is concerned. But still you can find the sum of total assets and the sum of total liabilities, they match. Now we move on quickly to another transaction, which is transaction 4. It says, given his lack of experience, David decided to make a small start. On July 4th, he bought rupees 10,000 worth of cement, as usual paying cash. Now just to make the transaction simple to start with, I am doing all the calculations, all the transactions involving cash alone. So right now we are not giving emphasis on non-cash transactions. We will see that in some different exercise. So what is happening? The company has purchased cement worth rupees 10,000, as usual in paying cash. How it will get reflected in your balance sheet? Now whenever you have purchased this, you have added in your stock. So stock under asset is increased and its value is now 10,000. And you will find that the cash has come down further from 125,000 to 115,000. But still the total assets possessed by the company is 150,000 and total liability remains unaffected. It is still at 150,000. So this is the position of balance sheet as on July 4 as far as Messrs ABC Trading Company is concerned. Now we will have one more transaction. Let's see what it is. Fortune favored David. On 4th evening, the government decontrolled cement. David promptly sold his entire stock of cement on July 5th for rupees 12,000 for cash. So transaction 5, the company has sold the entire stock of cement for rupees 12,000. Now let's look how the balance sheet looks like. You can see the stock has come down from 10,000 to 0 because all the stock has been disposed of. So from 10,000 it has come down to 0. Now the cash has also increased from earlier balance of 115,000, you have added 12,000 more. So your total cash available with you is 127,000. And you will find that under liabilities you have added one more row, that is retained earnings, and its value has increased from 0 to 2,000. And your total asset, if you sum it up, it is coming to 152,000, and total liability also it is 150,000. Now this may sound very tricky to you. Retained earning is nothing but the profit. How the profit can be a liability? But if you look at the earlier transactions, you will find that since the capital belonged to Mr. David and that was treated as a liability as far as the company is concerned, any profit that the company has made doesn't belong to him, doesn't belong to the company. So it is still to be treated as a liability because capital was given by somebody else. So, profit cannot be yours. So, this also, that means you have got added liability. That means from the previous figure of 150,000, now you have to take care of this 2,000 also. So, in that sense it is an added liability as far as the company is concerned. So, what you find here is that every transaction can change your composition of balance sheet. That is why it is very, very important to show the exact date on which you have prepared the balance sheet. And another thing important about this balance sheet is that at any point of time you will find that assets and liabilities, they balance each other. Now, for this set of transactions, if you try to work out the profit and loss account or the income statement, you must be able to notice the period. I have kept 1st July to 5th July. So, profit and loss statement is always for a particular given period, whereas balance sheet is always as of a particular date. So, income statement is basically able to tell you during this period how much money you have been able to generate. So, it is done in a very simple manner as far as this example is concerned. We have a sales of rupees 12,000. That means we have been able to sell our cement bag stock for rupees 12,000. And what was our expense? So, we got this for rupees 10,000. So, what is our profit? 2,000 for this particular period alone. Now, there are many other things such as expenses towards labor, expenses towards other things. Then in sales there could be different types of sales. Then after profit you have to pay for your taxes. So, profit after taxes, those parameters also are there in the income statement. But this is just to start with a very simple exercise, just to tell you, just to explain you what is meant by asset, what is liability, how in balance sheet assets are equal to liabilities, and so on. So, at this point of time we break and we reassemble at 6:30 India time. Maybe in another 15-20 minutes we reassemble for continuation of this particular lecture. If you have got any doubt, you may ask me right after the break or maybe after the end of lecture. Thank you.